Bloomberg News put out a big piece about Cliff Asness today, and Cliff is it weird to say like one of our heroes, or what do you like to say, friend of the show? I don't know. What's the way that you typically phrase it?
Not sure.
Okay. Well, we like Cliff Asness, and we read all his stuff, and we love when he annihilates people on Twitter. And
as long as it's not Barry.
Yeah, but I mean, he did like a 40-page paper the other day. I just read the front cover.
He has another 23-page paper on my screen right now. I can't get away from this guy.
You can't get away from him. All right, but anyway, so we're big fans, and I think one of the reasons we like him is because he's very honest and upfront, and he backs up everything he says about investing with data and with evidence, and he's been at it forever.
And he's bald. And he likes comic books.
Right. No, for all of these reasons and many more, we think he's great. And we were fortunate enough to have Cliff at our conference. Was that last fall? And he was amazing. He was on stage for an hour and just telling it like he sees it. So, but Bloomberg put out a really good interview with Cliff about what it's like to be a quant, what it's like to have a bias toward value in a market environment like this. And you pulled up some takeaways that I'm looking at Slack. Do you want to just take these one at a time? I think you had 5 things that you learned from the article.
Eric asked, the interviewer, David Harding, the quant.
Shout to Eric Schatzker at Bloomberg.
The quant who founded Winton Capital Management says this time is different. He's concluded that at least one factor or risk premium, trend following, doesn't work as well as it once did. He said he's reducing the weighting of that factor in his multi-factor funds and he's charging less for his trend following fund. To which Cliff replied, I believe he's doing that in response to competitive pressure from people like us who do trend following and charge less than he does. So he could blame us for this, and I'll happily take the blame.
Right. So trend following, essentially, it's not the same thing as momentum. However, it does tend to try to be on the right side of a market move up or down, or be out of the way.
I guess I would say defining trend following as working is very subjective.
Right.
Because are you trying to add alpha, or are you trying to just maybe get similar upside capture with much less downside capture?
Right.
So working and how long is it not working, and what sort of trend following rules are you using? So it's like a big catch-all.
Yeah, you could have a trend following strategy that's looking at 1 day periods of time.
Right.
And then you can have a trend following strategy that's looking at a decade.
Monthly, weekly, daily.
Right. So like everything else. Okay, what else?
Is it possible that many systematic strategies are so similar that they respond to the same signals by liquidating the same positions? And this is something that people worry about all the time. Well, what if everybody goes to sell? What happens when everybody goes to sell? Everybody's looking at the same thing.
Well, if every quant went to the same 5 colleges and learned from the same 5 professors and read the same books and worked with the same software, it's not outrageous to say that there's a lot of overlap and similarity between these portfolios.
So Cliff responded, it is. If I live to be 100 years old, I expect to see something like the quant quake again, which happened in 2007, summer of 2007.
Right.
There's no strategy in the world that isn't somewhat susceptible to what other people do.
Right. So you could say value investing is crowded. You could say growth at a reasonable price investing is crowded, and a lot of those people have the same portfolios. So I'm just pointing out that probably if there are 4 factors that we all agree are real, or 3 or 5, pick your poison, there's a good chance that there's a ton of money in the same stocks.
How much active trading is needed for accurate price discovery? Cliff answered, it's probably less than many think. And I've used this analogy, and maybe it's a bad one, but there's so many traders trading, and not just like people on Twitter, but giant dollar amounts on a daily basis.
Right. So,
and when you think about,
how many of them do you need to be buying and selling to say that
to get
price
reasonably fair prices? When you think about the real estate market, how many people are bidding on a particular house, just one home, and then how many buyers and sellers in a particular neighborhood?
Oh, probably 2 to 3 potential buyers for every house that's for sale, right?
Yeah.
And this, at least these
days. There's a few dozen houses on the market in each town.
Right. So there are thousands of people that are willing
to
buy
And now I guess,
Apple.
you could go up at the county level, state level, country level. But I guess the point is that really how many people does it take to get on this side and on that side and to come to a reasonable agreement of what something is worth?
So when we were out at Dimensional Funds, they did the jelly bean jar, and they were saying you need about 40 people, and you will take an average, and you will be shocked at how many times you can replicate that and come incredibly close to how many jelly beans. They said 80 is better, 20 is maybe not enough.
Right, so nobody guesses how many jelly beans are in the jar, but the average is pretty close.
Yeah, so the answer to your question, if 40 people can accurately, when you average them out, predict or come up with the number of jelly beans, how many do you need to be trading Apple? Do you need 50 million people? Probably not.
Right. So Cliff was asked about HFT.
Right.
And he made the point that it's not...
High-frequency trading.
He said liquidity has always run away in a crisis.
So HFT shutting down when the market drops and people saying, if that's the kind of liquidity you're offering, we don't need it.
He said it's not as if market makers 20 years ago were like, oh, no, I'll step in and take this loss for you.
Yeah. Actually, one of the greatest stories in the history of market panics is the 1907 example where there was no Fed, certainly no high-frequency trading. There were no buyers for any asset, and J. Pierpont Morgan had to wrangle all of the Wall Street heads of state into his library on Madison Avenue and basically tell them until we come up with a plan to start buying assets and ending the panic, no one's going home. So you've always had a lack of liquidity when you needed it. And so whether or not that's machines turning themselves off or people running away because they're worried about their own institution, I totally agree with that. I don't think that there's a way to mandate more liquidity.
A close second is the panic of October 4th, 2018.
Oh, man. I don't know if we're going to get through the end of the day. I
So,
wish you hadn't brought that up.
Lastly, he asked, you must have a vast trove of failed experiments. Have all the risk premia been identified? To which Cliff said, people have up to 6, 7-factor models, somewhat in that range. I would be willing to bet 20 years from now, we're talking about at least one more, but not 3 more, and maybe one of them we decided is crap.
Well, all right. So, like, is there a huge difference in the types of stocks you would own if you're weighting toward quality versus value or quality? Like, there's going to be overlap between almost all of those with the exception of momentum.
But he's saying that he suspects there might be one undiscovered.
Oh, something that we haven't. Well, what was the last to be discovered?
Profitability?
Profitability. And that's recent?
I think so.
And this stuff is like 30 years old, factor research, right? Early 80s?
Yeah.
Ish? Yeah, so it's not unreasonable. But the thing is, once you find it, what does that mean? Does that mean you start allocating toward it? Because you're not going to find it and keep it to yourself. You're publish.
I love the Mandelbrot quote about this. The trend has vanished, killed by its discovery. Something like that.
Yeah, so how about a sequel to that, which is when everyone agrees that it's dead, maybe that's when it starts working again, and not enough people have given up on some of the things that have stopped working? I mean, do you think there's something to that?
What do you think the prequel is?
Listen, Cliff, we have so much respect for you. We love the interview, and please keep writing, keep telling us about your research, and we'll keep reading
and keep wearing dad sneakers.
All right, cut.